So you want to buy securities in the stock market, but how do you actually do that? When you are here and the stock exchange is here, how can you bridge this gap? Well, one idea would be to fly to the US, walk onto the trading floor and shout, I want to buy some Apple. But the chance is high that you'll get stopped out by bouncers as the trading floor, like the dance floor of an exclusive club, is for VIPs only. Also, the costs would eat away your profits, so not a good idea. If you wanted to become a VIP, you'd have to go through training, get licensed, build up and maintain expensive IT infrastructure, as most of the buying and selling process is digital these days, comply with regulatory requirements, and undergo audits, which as a retail investor is pretty unrealistic to achieve. So the way around this is to snatch one of these VIPs, an expert that knows how the system works and that can help you with his expertise to buy or sell securities on the stock exchange. Even with those VIPs helping you, if you are a beginner, this can be a daunting experience. At least it was for me when I started out my investing journey over 2 decades ago. So in this video, I will figure out how these VIPs, also referred to as brokers, can help us to buy and sell securities on the stock exchange. Specifically, we'll look at the basics of how the stock exchange works, how brokers help retail investors like us, how to sign up with an online broker, and understanding the basic tools provided by the broker to stay informed and facilitate buy and sell orders. It is immensely important that you understand this process before you start investing or trading, as there can be quite a few pitfalls. So let's dive right in. First, we need to understand how stock exchanges operate. To envision, let's look at how this worked before computers took over. In the old days, and continuing to today for some markets, you called up a broker by phone or went to their office to place an order. The broker then interacted with traders to execute the order. Traders gathered physically on a trading floor, and securities trading was divided up to pits. If a trader wanted to trade a security, he went to the corresponding pit. The trader then opened with the open outcry system how many shares they want to sell. Other traders were shouting back if they were interested in accepting the trade, and if a match was made, both traders marked it down in their notebooks. At the end of the day, traders settled their books to ensure that all of their transactions were correctly matched with their counterparties. To be able to connect with one or several of those stock exchanges, you need to use a broker that has the IT infrastructure to connect to those exchanges and is licensed by the monetary authority and regulatory bodies in those countries to place orders on the exchange on behalf of retail investors. The system today is done electronically for many asset classes, and today there are 21 major stock exchanges in various countries around the world that each have a market capitalization of over 1 trillion. Now that we know how a stock exchange works and that we need a broker to access it, let's take a look at what kind of services brokers are offering us. There are a few types of brokers that we can choose from. A full-service broker, as the name suggests, is a broker that will offer personalized financial advice, portfolio management, and investment research. Services can also include retirement planning, tax advice, estate planning, and even access to IPOs if you have a company. So the benefit of choosing a full-service broker is that you have someone that will guide you every step along the way. This will, however, come with higher fees, which are often commission or asset-based. Full-service brokers are many times your regular banks, such as, for example, Morgan Stanley, Merrill Lynch, or UBS. On the other side of the spectrum, you have discount or online brokers. They offer primarily online platforms with self-directed trading. They don't offer personal investment advice, which means you need to figure out yourself in what to invest and when and how to place the orders. The fees, therefore, are much lower. Sometimes even commission-free trading is offered on stocks and ETFs. Some of the most well-known discount brokers are TD Ameritrade, E*TRADE, Charles Schwab, Fidelity, and so on. Another option, if you don't like humans and believe in the superiority of robots, you can go with a robo-advisor that offers automated, algorithm-driven investment with little to no human interaction. Robo-advisors usually are low cost and possibly a good pick for passive investors. When you want to play with the big boys, you can choose a direct access broker which is designed for professional or day traders who need direct market access with high-speed execution. You will require knowledge of market orders and pay high per-trade fees. Examples of direct access brokers are Interactive Brokers and TradeStation. And as if it's not already confusing enough, there are hybrid brokers that combine elements of full service and discount brokers and offer human advisors along with self-directed trading options. Examples are Charles Schwab via the Schwab Intelligent Portfolios or Vanguard Personal Advisor Services and a few others. So, which kind of brokerage should you choose as a beginner? Well, if you prefer to rely on professional advice, then you'll have to spend more money and go with a full-service broker. But if you want to take finances into your own hands, want to invest into ETFs, or are mindful about costs, an online discount broker makes more sense. Let's recap. We know how the stock exchange works. We need a broker that helps us to place orders on the stock exchange. We know that there are different kinds of brokers that we can choose based on our needs, but not all brokers are banks. So you might ask yourself the question, is my money secure with those brokers? When we open a bank account, we will receive our own account and can do money transfers to other accounts of other people, companies, or investment accounts. Bank accounts are usually insured up to the sum of around $100,000, but this will vary from bank to bank. So if a bank goes bankrupt, if you have over $100,000 on it, you might lose that money if the bank goes bankrupt. But how does this work with a well-regulated broker? Usually brokers will work together with banks and clearing firms to safeguard their clients' assets. The bank will provide the trader so-called omnibus accounts to manage their customers. So if you send money to the bank account of your broker, the broker will register that the payment came from you and credit it to your online brokerage platform account. Omnibus accounts are not directly insured the way individual accounts are. Instead, the protection depends on the type of financial institution, the regulatory framework, and the specific agreements in place. So it depends heavily on the broker what protections you have. For US stocks, there is a general protection through SIP-C. If the brokerage firm fails, SIP-C provides protection up to $500,000 per customer, including up to $250,000 for cash. But omnibus accounts are typically treated as one account, meaning that the coverage applies to the broker, not to the individual investors. However, if the firm properly records individual ownership, clients may still receive pass-through protection, meaning they might get individual SIP-C coverage. There might also be FDIC protection. If an omnibus account holds cash in a bank, FDIC coverage may apply up to $250,000 per depositor if the broker maintains proper records for individual clients. Otherwise, the account might be treated as one entity, limiting protection. Some brokers carry additional insurance beyond SIP-C limits. Private insurers like, for example, Lloyd's of London provide excess coverage, but it varies by firm. In Europe, omnibus accounts are regulated under MiFID II, requiring proper record keeping and protection under national investor protection schemes. In Canada, SIP-F provides similar protections to SIP-C. Second, FINRA rules require brokers to segregate customer funds from their own. The broker must not mix his own funds with customer funds as per regulation. This means that if the broker goes bankrupt, your funds will remain unaffected and you will be able to contact the monetary authority in your country and transfer the invested funds to a new broker. But there is, of course, no protection if the stocks or bonds you invested in lose value due to economic events or stock market fluctuations. All those protections will vary from broker to broker and country to country. Therefore, it's important that you clarify with your broker how your uninvested cash is protected, so the money that you have transferred to the broker's bank account and is kept there, and how your assets are protected, so the securities like stocks and bonds that you have purchased. If you decide to invest through a full-service broker, then you are basically set, as the full-service broker will give you direct advice. But what is if you want to take investing into your own hands and go with an online or discount broker? Let's take a look at how this works. The first step will be to sign up with the broker. This can be an unpleasant step, as the broker will require you to provide a lot of information, such as your passport and ID card details, face recognition, documents that prove where you live, how much money you have, and so on. And you might feel a little intimidated to provide those details. The reason why the broker needs this information is mostly due to regulatory requirements called KYC, or Know Your Customer, to determine your risk profile and protect you from investing in certain products and to prevent fraud. Don't worry, you will always be able to change that later. So if you want to invest into ETFs, you don't need to activate investing into stocks or bonds, for example. At some point, you might get asked if you want to open a cash account or a margin account. What is the difference? A margin account is an account where you can automatically lend money from the broker to leverage up your investments. I would advise against this account type if you are a beginner, as you could lose more money than you own. And you need to be careful, as money you lend will cost you interest. You can always change your account to a margin account later if you need to. To better understand the process, I'm showing you the interface of one of the brokers I use. I'll only cover the basic functionality that every broker will have in one way or the other. Now that that's out of the way, once you're signed up, you'll be greeted by a dashboard that shows you information about your overall investment portfolio and some news. The first thing you'll have to do is to fund your account. In the top menu, there is a button called Transfer and Pay. If you click on it, you can see a button called Transfer Funds. You'll want to deposit funds, so let's select that. Depending on the currency or the amount you transfer, the broker might give you a different account to send your money to. That's why the broker will ask you to provide those details. Click on the Use a New Deposit Method and select your currency. Select your transfer option and click on the Get Instructions button. Enter the amount you want to send and click the Get Transfer Instructions button. This will then show you the bank account and details to wire your money. If you want to withdraw funds, it works similar. Select Withdraw Funds and follow the instructions to tell the broker where to transfer the money to. Please take note that withdrawals might come with some cost. So now that we know how to fund the account and how to withdraw money, let's continue. The next step is to convert currency if the currency of the security you want to invest in is different to the cash you hold. For example, in my case, I hold my cash in Singapore dollars. When I want to purchase a US-based ETF, I'll need to convert some money to US dollars. Some brokers do an automated currency conversion when you buy an asset, but I prefer to do this manually. To convert currency, click on the Trade button in the menu and select Convert Currency. You can now enter the details from which currency you want to transfer to which currency. If you look to the right, it will show you how much cash you have in each of the currencies. Once this is done, you can now start to open orders to purchase securities. Let's say you want to invest money into the Vanguard World ETF with the ticker symbol VT. For this, click on the blue Trade button at the top right. An order ticket will be opened where you need to provide the ticker symbol. Let's use VT and then choose if you want to buy or sell. In your case, you want to buy. So enter VT into the top search bar and you should then be able to choose the ETF from the list. Next, you need to define the quantity you want to buy. You can insert one, for example, to purchase one share, and below it will show you the estimated price. If you have activated fractional shares in your settings, you can also use a dollar amount. So change from shares to US dollar and enter the amount, as for example $10. As you can see below, it will show that you'll buy 0.08 shares only, so a fraction of a share. Next, there are different order types. I'll only explain two of them. The first one is the limit order with the limit price that is selected by default. This order type will only buy the shares if the price of VT is at or lower than the limit price. This helps to ensure that the order is not executed with a higher price. The other order type is a market order. This order type will buy shares at the current market rate immediately. As long-term investors, we do not care as much as we drip feed on a monthly basis, so both order types will be fine. Time in force means that if the order couldn't be executed within a specific time, it will be auto-cancelled. You can leave the rest of the options as is. Then you can click the buy button to initiate the purchase. When you sell shares, be careful that you enter the right amount of shares so that you don't sell more shares than you own, as this could potentially trigger a short sell. So you know now how to deposit and withdraw money, and you know how to place orders on the exchange. But where can you see an overview of what you have invested in? And what does all this other stuff mean? Let's go through the most important menus. On the dashboard, let's first look at what the chart represents. Up here, you can see two buttons. One says value, the other one says performance. Value is the monetary value of your cash and securities you bought combined and how this changed over time. You can see that the value of my account is growing but fluctuates a little over time. These straight lines up that you see are deposits of money into my account, and those gradual increases or decreases are my investments going up and down based on market events. Down below you can choose different time frames, and on the top you can see the total value of the money in your account and the change in monetary value over that period. When you switch to the performance view, you see how the total portfolio, which means all securities together that you purchased, have performed over time. Next, let's look at positions, which are an overview of your securities holdings and cash holdings. In broker terms, position refers to the amount of shares you own. So what this overview tells you, for example, is that you own 100 shares of the JEPQ ETF, which is worth $53.81 per share at this time. Market value is the total value of your holding in the ETF or in other words, the number of shares times the current price. If you click on one of the ETFs like JEPQ, it will show you more details. So you can see a detailed candlestick chart and information. On the right, you can see that we could directly place buy or sell orders here. We can see the market value, the amount of shares, the total return, and the unrealized profit and loss. Up here you can see two other buttons to get more details about fundamentals and news. Let's click onto fundamentals. This page will give you a ton of valuable information about this ETF. So this fund focuses on regular income through dividends and option strategies, while also trying to get some growth. On the profile and fees page, you'll see the expense ratio. So what you need to pay in fees on a yearly basis, which is 0.35% of your invested capital. And you can also see how much money is in the fund through total net assets, which is 23.44 billion. On the performance page, you'll see how the fund performed. Holdings will show you the top 10 stocks the fund invests in, the industry allocation, and the geographical allocation. And if you click on the news button, you'll see some news in relation to the fund, research reports, and so on. To wrap it up, if you want to buy securities such as ETFs, stocks, or bonds, you need to go to a stock exchange. You'll need a broker to help place the orders on the stock exchange. If you choose a discount broker, you can place the orders by yourself through a platform. You learned that you'll need to check how your cash and securities holdings are insured in case the broker goes bankrupt. You've also learned that the insurance will depend on the broker, the country, the security itself, and the regulatory bodies, and how such insurances could look like through SIPC, FDIC, SEC, FINRA, MiFID II, and so on. In addition, you learned the most important points when signing up with an online broker, how to fund and withdraw money from your brokerage account, how to place orders for securities purchases or sales thereof, and how to get information about the securities or your overall portfolio. I know this was quite a lot of information to take in, but I hope this helped you to give you a clearer picture and sufficient details. If you want to learn more, videos should pop up here or here. Have a good one and see you in the next video.